If you trade boom and crash, then you already know how frustrating it is to miss spike or enter too early. That is why in this video, I will be showing you a sniper entry strategy that will help you to catch high probability spike without using any indicator. So without wasting much time, let's dive into the video.
So guys, before we proceed, I would like to call your attention to an important thing. Boom and crash is a special instrument that is offered by a specific broker. So if you're using some brokers like XNex, Infinox, and many other brokers, you may not be able to see this pair there. You cannot trade boom and crash. So the only broker that offers this pair is the Deriv synthetic broker. So if you want to set up your account, I've made the link available in this video description. So you will need to set it up so that you'll be able to participate in this amazing pair. So you can click the link in this video description to do justice to that. It is pretty simple. You can set up your account in less than 3 minutes just with your available email. So having said that, now let's look at how you can successfully trade boom and crash and avoid the mistakes that a lot of persons are making or what they are mixing out in trading this amazing pair. So to do that, let's look at an important concept that I'm sure you guys must have heard of, which is the concept of demand and supply. Now, hearing about it or knowing about it is not as important as your ability to apply them in order for you to make tangible profits. And that is why you need to pay attention to the rules that I'll be giving you to apply supply and demand while trading boom and crash. Okay, so we have learned so far that a supply candle by definition is the last bullish candle before a massive push to the downside, and a demand candle is the last bearish candle before a massive push to the upward direction. Now let's quickly look at some chart example of how we can identify a demand and supply candle. Now this candle right here, the bearish doji candle that you're seeing here, is an example of a demand candle because it is the last bearish candle before we are seeing a move to the upward direction. This is also an example of a demand candle because it is the last bearish candle before we start seeing a push to the upward direction. Now this candle right here is also an example of a demand candle because it is the last bearish candle before we start seeing a massive push to the upward direction. So you can now identify a demand candle anywhere you found yourself. Now let's push to identifying a supply candle. By the definition, we have said that a supply candle is the last bullish candle before a massive push to the downward direction. Last bullish candle you will see before price selling to the downside represents your supply. Now this is an example of a supply candle. This bullish candle that I marked out is an example of a supply candle because it is the last bullish candle before a massive push to the upward direction. All right, so this candle right here, this bullish candle right here, is also an example of a supply candle. This is also an example of a supply candle because it is the last bullish candle. Pardon me, I don't know why I like bearish. It is the last bullish candle before we start seeing this massive drop to the downward direction, right? So this is also an example of what a supply candle. This right here is also an example of a supply candle, this candle right here. Now you can successfully identify both a supply candle and a demand candle. Now the question is, how do you apply them while trading boom and crash? Does that mean that anytime you see a supply candle, you should sell, or anytime you see a demand candle, you should buy? No. And that is why you need to have a good structure as a trader, which I'm going to explain just right now. Now that you understood what to do, let's assume that you want to analyze a particular crash or boom pair to trade. The first thing you must understand, or the first question you must ask yourself, is to identify the trend of the market. So when you identify the trend of the market, every other thing becomes pretty easy. For instance, if you want to trade this, the first thing is to check whether the market is trending to the downward direction or to the upward direction. Now you should understand that boom and crash have special characteristic. Okay, they have special characteristic. Now what is this characteristic? A crash pair will always have a spike to the downward direction. That's why they call it crash. It will always have a spike to the downward direction. But a boom pair we always have a spike to the upward direction. Now take for instance, if you notice that a crash pair is bearish, now you have more reasons why you should take or look out for a sell opportunity. Why? Because the spike will be happening in your direction, and mind you, one spike alone can give you a lot of money. So imagine you trading alongside with the trend and you have like maybe 3 spikes consecutively. In few seconds you would have made a lot of money, right? So that is why it is always important that if you find a trending crash pair that is in a bearish move, always look out for high probability setup for a sell. And if you're looking out for a buy on a boom pair and you notice that the overall trend is bullish, understand that you have high probability setup and you can make tangible amounts of money, right? So now let's see how the setup looks like when you want to execute a trade plan. So suppose price is trending to the downward direction in this manner. Price is trending to the downward direction. So this is an example of a schematic example of a bearish market, and also let me give you a schematic example of a bullish market. So first thing first, you need to identify the most recent break of structure. We have identified that this market is bearish as are the case of this, right? Now we want to mark out the most recent break of structure. Now when you mark it out, the next thing is use your Fibonacci to check and wait until price retraced above the 50% fib level. I think I wrote it somewhere. Here. Yeah, this is it. So the first thing you must do is to look out for what the nearest supply that is above the 50% fib retracement level after a break of structure. That should be the complete statement. After a break of structure, it should be there. So right now we have been able to identify a break of structure. We've drawn our Fibonacci retracement from this high to this low. Now we are waiting for what price to give that retracement. That retracement is very, very important. Okay, so we are waiting for price to give that retracement from here. So what it means is we are not looking to take any sell opportunity from here until price crosses above this. So we cannot start looking out for a supply candle around here. We can start looking out for a supply candle around here or anywhere along this line. So that is what I mean by that. So if you see a supply candle below this 50%, you are not interested in it until price is above the 50%. Now, similarly, if you are looking out for a buy opportunity, you also need to identify your Fibonacci retracement or use it to draw it out and then identify the 50% level, which is this. So you are not interested in taking any buy opportunity from this point anywhere around this region until price breaks below the 50% Fibonacci retracement level. Then you start looking out for your demand candle. So in essence, you look out for a demand candle when you want to buy, and you look out for a supply candle when you want to sell. So I hope that is taken. Now let's look at that example of some of the explanations that I have given to you so far. So this is what the statement means is what I have explained to you. For a supply or for a bearish market, you look out for a supply that is above the 50% Fibonacci retracement level after a break of structure. Now, where is the break of structure? This is when price broke this structure. So we are looking out for what a supply that is above this 50%. Now, for a buy, now if the market is bullish, after this break of structure has occurred, we want to draw our Fibonacci retracement tool, and then we are waiting for price to retrace below the 50%, and then we look out for the nearest demand candle, and we can have our trade execution from that zone. So, like I said, let's quickly look at some areas where these things are, playing out, so that we don't waste much time on this video. Okay, so here is one area where it's playing out. Now we have our break of structure as marked out here. This is the break of structure. So let's use our Fibonacci tool to check. Okay, and this is the 50%. And we said that since the market is trending to the downside, we want to look out for the nearest. We want to look out for the nearest. We want to look out for the nearest. We want to look out for the nearest supply, right? After the break of structure has happened, that is above the 50%. Now this is the 50%, this is above it. The nearest supply candle is here, and that is exactly where price reacted to. And look at all this huge move that you're seeing happens because of the spike that I talked about, and the spike is happening in your direction, and before you know, your TP is, your TP will be smashed. So there are other places where it is happening. This is the supply, price reacted to it, and boom, started spiking to the downward direction. Now here is another good example. We have our break of structure right here. Between this high and this low, we've drawn our Fibonacci tool, and then this is the 50%. So we want to look out for a supply that is above the 50%. This is the supply. Price came back to this supply, and see how massive the sell-off is. The same thing, this is the current market price. This is the current market price, and when price gives this break of structure here, we have our Fibonacci tool telling us or helping us to identify when price has retraced above the 50%. And here is the supply candle. Let me zoom out so that you can see it clearly. So here is the supply candle, and that is what is causing this current price reaction that you are seeing. That is what is causing this current price reaction that you are seeing. So let's quickly look at examples from a boom pair. So let's choose a boom pair to also look out for this example. Okay, let's just use the first one. All right, so now let's zoom in to see where price is coming from, where price is going to. Okay, we can clearly see that the trend of this market is what? Is bullish, right? So now let's take a look at this particular place where some of these things that I've mentioned so far are happening. Now, since the price or market is bullish, we'll be looking out for what? Demand. We'll be looking out for demand. If we are in a bearish market, we'll be looking out for supply. But if we are in a bullish market, we'll be looking out for demand. Okay, so look at what happened here, right? Price gave us a break of structure, so we have between this low and this high. So this is below the 50% fib level. This is the 50%. Everything's happening here is below the 50%, right? And like I said, we need to look out for the nearest demand after that, that is below the 50%. And you can see that price came to this demand and started buying massively to the upward direction. Now here is another place where these things are playing out. If you look at this, we have a break of structure here. Okay, and we have between this low and this high right here. Now everything here is below the 50% fib retracement level. Now I said we should check out for what? The demand. We can choose this. We can look at this particular point and we will say that this is the nearest demand candle, right? Of course, you are right. But then you have other demand candles that are there. And how do you know which one will work? I will always advise that anytime you see more than two demand, understand that some of it could just be an instrument of liquidity. What do I mean by that? If you look at this point and this point, this is the market creating substructure. Sometimes those things are acting as liquidity. So the safest place is if you have more than 3 demand showing you below the 50% Fibonacci retracement level, you should always pick the one that is at the extreme, which is this particular one. the one that is at the extreme, that is the one you should select. And you can see that immediately price came in contact with it, we have a massive buy to the upward direction. Okay, so these things are littered everywhere on the chart. We have our break of structure here, and this is the demand that caused this reaction. Price came to this demand and bought all the way to the upward direction. Okay, so the same thing has happened here. Now look at this angle. We have our break of structure here. This is a demand candle, right? Price retraced to it and bought all the way to this point. Now price has not broken the most recent high, right? But if you are trading and you are not a greedy person, you would have taken your profits here, because this move should be at least 1:3 risks to reward. So let's use our tools to check how many risks to reward is this. So if you are entering from here, obviously your stop loss needs to be below this point. Your stop loss needs to be here. Now, how many risks to reward is this? This is 1:3.63. That is almost 1:4 risks to reward ratio. So you would have taken your profit from this point. So that means you would have had like how many wins on understanding this simple entry strategy to trade boom and crash. So if you find this video helpful and this is your first time of viewing my content, kindly make sure you subscribe and like this video, right? You can comment if there is anything you want us to, create video on, or if you have any confusion while watching this video, drop your comments in the section, or also tell us how you have been trading your boom and crash and what are your experiences so far, so that others can learn from your own experience. Okay, and if you don't have a trading account, like I rightly said, you can use the link in the video description to set up your account. And don't forget to join our Telegram channel. The link is also available in the video description. We drop daily updates and free signals. We host live classes to help beginners understand the markets much more better. So this is where we'll be stopping today, and I hope to see you in our next video. Peace out, guys. Honor Skid Case.